Our next guest says to enjoy this rally while it lasts because this could be as good as it gets for a while. Let's bring in Lori Calvasina, head of U.S. equity strategy at RBC. Lori, great to have you back.
Thanks for having me.
You're in the midst of this conversation, so I was going to ask about your target. I'll put that off for a minute. But in terms of this debate on where you put your money in this market environment, because we are pretty much at your target.
Right.
Where would you go?
So we like utilities, we like consumer staples, we like financials. The thing that all three of those have in common are dividends. And what we've historically seen is that when you're going into easing mode by the Fed, stocks with high dividend yields outperform the non-dividend payers pretty strongly. We've also seen that the consumer sectors generally act pretty well in an easing environment, as do the financials, ex the financial crisis.
So Dan's point about valuations of, say, a Coca-Cola sugar water company, what's it trading at? 25 times. Does that concern you? I mean, is there a point at which, even though this is the time in the cycle where you want to be in these names, that it doesn't work?
Well, what's interesting to me about consumer staples is if you look at the valuations beyond PE, they actually still look pretty undervalued versus the S&P on things like price to book or price to cash flow. Yeah, so it's, you know, the PEs do give you some sticker shock, but if you dig a little bit deeper, expand beyond the PEs, you can come up with a valuation case pretty easily, frankly, easier than what you can come up with in the REITs or the utilities.
So when you take a look at the sectors that you like, it's defensively tilted. What does that mean in terms of your view of the economy?
Well, I would say the financials is more of a cyclical bet. It's where we see a lot of opportunity on that side. And we do within some of the other sectors like industrials. We think machinery looks pretty de-risked. We like the brick and mortar retailers within the consumer discretionary space. So I think you can pick your spots cyclically, but we do want to be pretty evenly balanced between the cyclicals and the defensives at this point.
Lori, if you think about the rest of the world, is there a trade that is more interesting after there's certainly been underperformance by, I was talking about Japan, and ultimately you can make an argument that the earnings revision ratios in Japan and the dividend payouts are much better than they've ever been.
Well, I haven't looked at Japan specifically, but what I can tell you is that the U.S., if you look at global equity funds, it's an extraordinarily crowded trade. We saw a little bit of rotation out late last year, and then it popped right back up this year. There's always a premium in the U.S., and right now that premium is pretty much at all-time highs. So I do think global investors are looking for other places to put their money, but the catalysts are just not presented themselves.
So you talked about dividend yield. When you think about it, we've been essentially for 10 years in a zero interest rate environment, and now globally we have a negative interest rate environment, and maybe that's coming here, and that may be one reason to explain why Coke is trading 24, 25 times or something. But is that just a massive bubble waiting to burst at some point if we ever get to normalize interest rates?
Well, I don't think the bubble is sitting in the dividend yielding stocks by any stretch. I mean, we've had a decade of growth outperformance relative value. If there's any bubble in the market right now, I think it's in certain parts of TIMT, things like entertainment, things like software and IT services, where you've got nosebleed valuations. You've also got unbelievably high allocations in hedge funds, the fast money trade to these areas of the market. So, we don't deny that the fundamentals there are great, but everybody's already there. I'm much more worried about that part of the market.
You don't think the Fed's going to cut in July?
So, I look at it from this way. The Fed has continued to tell us all they are data dependent, so let's look at the data. And what I think we saw today with the ISM data, for example, is that it's slowing, but it's not really turning negative yet. Now, we did have some lousy regional Fed surveys, but the actual data itself is not really, slipping into negative territory. I think they've got to provide a justification. We thought our house view was that maybe if the trade negotiations went badly at G20, that might force the Fed's hand. I think that was fine. I wouldn't say it was any kind of, huge positive, but it certainly wasn't a negative.
Lori, great to see you. Thanks for coming by.
Thanks for
Lori Calvasina of RBC Capital Markets. What do you make of sectors?
So I don't like the financials. I think that it's been all the picks are good, but they're market perform picks. I want something that's outperformed. So if you look at the home builders,
you mean they're market perform picks for you?
Yes.
In your view.
Yes, for my view, and there's nothing wrong with them. They're all up about 14% or 15%, which is the market's up 16%. I like the home builders. I like that play. I like tech. I like staying in that. I do believe that the market can go higher from here, so I want to put a little bait on.
So not a big fan of the defensive sectors. Like you said, I can't pay 25 times for sugar water that's growing earnings at 5-ish% per year. Just not of any interest to me. I'd much rather get involved with companies that are going to be growing their earnings at a much faster pace, hopefully double digits. So med tech's an area we like right now. software. So there's different areas that we like. Not a big fan of the defensive sectors.
Everybody's really piling up on your sugar water company.
Look,
Tim.
I mean, that's a reason why the stock continues to go higher, because I think people have been questioning what Coke's doing. Like, I don't need to go to bat for Coca-Cola. The point is, and I think Lori did a great job of framing stocks that are not in a bubble, as she put it, on other multiples. And I think there's no question Coca-Cola has been investing in other businesses, in vitamin waters and in other things. Maybe one day they'll even be, in cannabis. But these companies that are cash flow generative at a time when the rest of the world looks really nasty are places where investors are going to go. We've seen it the last 5 years.